Hello. Hello. Thank you very much. Thank you for joining us once again and welcome back. We are discussing today profit margin scheme, decoding UAE VAT law. The law was introduced in 2000, the end of 2017, beginning, it was effective starting from 1st of Jan 2028, 18. So we are discussing profit margin schemes. In the profit margin scheme, this is a very small topic, but bit technical. We'll go through along with a few example. We'll go through the checklist as well. We'll go to the public clarification. We'll go to the summary. We'll go to the law, and we'll go through the regulations as well. So profit margin scheme, whatever we have discussed today, we have conducted around 71, 72 webinars as of today, and this is our 73 webinar. Profit margin scheme. Before going into the detail of the profit margin scheme, just look into this illustration. Just look into this example. Scenario is basically how VAT works. We all know this, how VAT works. VAT works like this person. This is a VAT registered supplier. This supplier has bought one car in 2018. Whenever the person is buying the car, definitely they will be paying input tax. Whatever the input tax they have paid, they would claim it back from the FTA. Whenever they are selling the car, assuming they are selling the car at 100,000. Once they are selling the car at 100,000, so 100,000 is the sales price, they will be purchase price as well. Here they will be input tax, here will be output taxes. Net amount will go to the FTA 5K less the input tax. Now this is the VAT registered trader. This VAT registered trader is buying the car of 100,000. When they're buying the car, VAT applicable on the purchases is 5,000. We know this input tax is our asset. We have right to take it back from the FTA. So 5K is our asset. We will take it back from the FTA. When this person is selling the car, assuming this car is being sold at 150,000. So this will be subject to output tax 150,000 into 5, 7.5K. So this is my output tax, this is my input tax, this will be netted out, net amount will be paying to the FTA is 2.5K. So this is how VAT works. This person, VAT registered trader, is the presumed collector of the government. This person is collecting the money on behalf of the government and depositing to the government after adjusting its own input tax, which is 5K. This is how VAT works. And when this car is being sold 150K plus 5%, VAT at the top of the car is 7.5K. This is an end user individual, assuming Mr. A, B, C, whatever is. This 7.5K net output tax will become the cost of this end user. So since 7.5K will become the cost of this end user, so this is called, based upon this called, end user bear the VAT, or this is the reason this is called consumption tax, because the person who is using the car, that person will be subject to pay the VAT. So if you're going through this person has ultimately paid 7.5K, but the government has collected 5K from this person, 2.5K from this person, to net 7.5K, but this person has collected 7.5K passed on to the FTA. This person has collected 7.5, paid 5, net gone to the FTA 2.5. On overall basis, 7.5 has gone to the FTA. This 7.5, the burden of this 7.5 has been borne by the end user who is using the car. Now the question is, can we apply the profit margin scheme? What is the profit margin scheme? Profit margin scheme is asking, loss is basically you need to pay the tax. You need to pay the tax on the profit instead of claiming tax on the input tax, instead of on the purchases, instead of paying output tax on the sales. So this is called profit margin scheme. Assuming we are buying car of 100,000. We are selling this car of 121,000. How much is our margin? Our margin is 21,000. This 21,000 profit margin scheme says it will be considered inclusive of VAT. So we need to calculate the VAT. It will be 5 divided by 5, 105. VAT amount will be 1,000. So this is the profit margin scheme. On this 100,000, we should not claim input tax. On this 121,000, we should not charge output tax. We need to consider how much is our margin. Margin is 21,000. We need to assume this margin is a VAT inclusive value. 21,000 into 5 divided by 105. 1,000 is the net VAT that will go to the FTA. But this profit margin scheme, as per the law, is subject to some certain conditions. What are those conditions? Those conditions are the goods, specific good, because this profit margin scheme is not applicable to all goods. We'll look into this on which goods profit margin scheme is applicable. So the goods on which profit margin scheme is applicable, specifically those goods has been bought from the individual who is not a VAT registered party, or the company which is not a VAT registered party, these goods have been bought from the person who is already applying the profit margin scheme. These are the two conditions initially. The goods are being bought from the individual. Specific goods. Specific goods are being bought from the unregistered person, or these specific goods are being bought from the person who is already applying the profit margin scheme. This is the first condition. Second condition, the goods that are being bought, that goods has already been registered in the UAE, and tax on these goods has been paid at the initial launch of the goods. Means if the goods have been bought before 2017, then profit margin scheme cannot be applied. If the goods are being bought from the registered person, profit margin scheme cannot be applied. If the goods are being bought from the person who has already bought the goods before the effective date of the law, before the implementation of the law, now the person is telling profit margin scheme is not applicable. These are the few initial conditions. Based upon this schemes works. So if considering these conditions, what are the conditions that we have discussed initially? As I said, goods are being bought from the individual or the person who is already applying the profit margin scheme, and these goods has already been taxed in the UAE. These are the two major conditions. So in this condition, supplier is a VAT registered person. This supplier who is supplying the good, this is a VAT registered person. If this supplier is a VAT registered person, we cannot apply the profit margin scheme, because the requirement of the law is the goods are being bought from the individual VAT unregistered party, or the person who is already applying the profit margin scheme. Then we can apply the profit margin scheme. Otherwise, we cannot apply the profit margin scheme. In this illustration, goods are being bought from the VAT registered supplier, so we cannot apply the profit margin scheme. We need to apply VAT in the very normal way, because this person will be claiming input tax on the purchases, then charging output tax on the sale. Net amount 2.5K will be going to the government. We cannot apply the profit margin scheme. Next, this is a second example. The supplier is a VAT unregistered. So first condition is met. The supplier is a VAT unregistered party, and then car registered in 2017. So means when this car was first supplied, the goods were first supplied in the UAE, these goods were not subject to tax at that time in 2017. Assuming this is the unregistered supplier, Mr. A is here. Mr. A bought his car in 2017 before the effective date of the VAT law. Now Mr. A wanted to sell the car, going back and selling this car to the company. The various companies are in the market, there's Mazda is there and all this. And now this Mr. A wanted to go and sell this car back to the supplier, which is the VAT registered supplier. VAT registered supplier will buy the car, then they will sell it into the market. Assuming they bought this car from this VAT unregistered supplier from Mr. A, but Mr. A bought this car before the effective date of the VAT law. Since they bought the car before the effective date of the VAT law, so we cannot apply the profit margin scheme, because the condition for the profit margin scheme, the goods are being bought, specific goods are being bought, as I mentioned earlier, from the individual, a VAT unregistered party, or from a person who is already applying the profit margin scheme. And now in this case, goods are being bought from the individual, but the individual has bought the goods before the effective date of the law, means this car has already not been taxed in the UAE. When this car has already not been taxed in the UAE, so means we cannot apply the profit margin scheme. So this company will be buying the goods. The VAT will not be applicable here. This will not be any input tax. Now this company is selling the car assuming 150k in the market. They will straightforward apply 5% on 150k, which is 7.5k. They will deposit the 7.5k to the FTA. But we cannot apply profit margin scheme. The reason is goods has already not been taxed in the UAE. Third is supplier is a VAT unregistered person. Yes, this is correct. Car registered in 2018. Yes, now there is a possibility we can apply the profit margin scheme. I just wanted to highlight this profit margin scheme is an optional scheme. This is not compulsory scheme. This is optional. If you wanted to apply, you can apply. If you don't want to apply, there is no requirement, compulsion by the government from the FTA that you need to apply the profit margin scheme. Now this is the same individual. This individual has one more car, Mr. A. Mr. A has bought this car from the various any auto seller company in 2018. When this car was sold to Mr. A, this selling company, because the car manufacturer or trader, whoever is in the market, they have sold the car, they have paid output tax to the FTA, means this car was registered in the UAE after the effective date of the law. So tax on this car has already been paid to the FTA. So both of the conditions are being satisfied. Tax has already been paid to the FTA and the car is being sold by the unregistered party to this registered trader. Now this registered trader, if they want, they can apply the profit margin scheme, and if they don't want, they cannot apply, they should not apply the profit margin scheme. I just wanted to keep in front of you. A lot of people are asking why we have applied the profit margin scheme. This is complex. This is reporting is complex. We should go straightforward, keep it simple. I just wanted to give you the scenario because the biggest advantage from the profit margin scheme is you will lose the competitive advantage from the market. If you are not applying the profit margin scheme and your competitors are applying the profit margin scheme, then you will be out of the market. They will be in the market. I just wanted to give you an example. Now this party, VAT registered trader, this VAT registered trader, 150k, this is selling price. Now if this person is not applying the profit margin scheme, not applying. If this person is not applying the profit margin scheme, what will be sales price in the market? 150k plus 7.5. It will be 157.5k. This will be the selling price in the market if you are not applying the profit margin scheme inclusive of VAT. And you know this, the law says that you need to disclose the prices. If you are displaying the prices, it should be inclusive of VAT. And I'm assuming they are selling the car 150k, but the prices that will be displaying in the car, it will be 157.5k. This is the selling price. This is the company A, which is buying the goods. After buying the good, they are selling into the market and they are not applying the profit margin scheme. Now this is company B. This company B is applying the profit margin scheme. Yes, they are applying the profit margin scheme. At what price they will be selling the car to the end user? They will be selling the car to the end user 150k. 150k will be assumed inclusive of VAT. What is their purchase price? 100. So this company is selling the car in the market at 157.5k. This company is selling the car into the market at 150k. For sure, people will come and buy this car from here. So you will lose the competitive advantage of the market because you are not applying the profit margin scheme. Now, what is the loss to the benefit to the government? In this case, government is collecting how much tax? Government is collecting 7500. Right? Government is collecting 7500. And in this case, how much government is collecting? Government is collecting 50k. No, sorry. Yeah, 50k. 50k into 5 divided by 5, 105. Here government is collecting 50k into 5 divided by 105. 50k into 5 divided by 105. Here government is collecting No, sorry. Here government is collecting 2380. Here government is collecting because they have not applied the profit margin scheme. This is their output tax. The input tax here is 5,000 because no. They when they are selling this car into the market 150K into 5, yes, government will be collecting 7500. And when this person is selling car into the market, their VAT will be how much? 2380, almost 2380. And just I wanted to tell you, this VAT is an incremental cost. How much is the value addition? This is called value added tax. How much is the value addition here? 150K less 100K. 50K is the value addition. Principally, 50K is the value addition, but on this they don't have any input tax. Then that amount will go to the government 7500. Government will be collecting 7500. In this case, how much will be going in the pocket of the government? 150K less 100K, 50 to 2380. How much is the value addition? 50K. Principally, this is the value added tax, and we need to pay 5% of the value added tax will be 2500 if we are asking principally. So 2500 less 2380, still this is a, here we are paying extra tax, here we are paying lesser tax. So crux is basically what I am trying to say, value addition is 50,000, but this party is paying tax on 150K, which is against the basic principle of VAT. So principally VAT would have been on the value addition. Might be this is the reason that we have implemented this profit margin scheme. Second important thing is that they wanted to remain they wanted to remain competitive into the market. Once the businesses wanted to remain competitive into the market, they can apply the profit margin scheme as well. As I already told you, here the price will be 100 and here the price will be 157.5. Here price will be 150. They have the competitive advantage over their competitor in the market. So this is the reason if your competitor applying profit margin scheme, then you need to apply the profit margin scheme as well. Otherwise, you will be out of the market. So in this situation, yes, we can apply the profit margin scheme. I told you the reason in case you are not applying, in case you are applying, what are the benefits. In both of the cases, you can see applying the profit margin scheme is beneficial. Now this is another scenario. In this situation is same like the previous example. Now this VAT registered trader is selling the car to another VAT registered trader. The important thing is this VAT registered trader is applying the profit margin scheme because this person when buying the goods from this individual, car registered in 2018, per seller is unregistered person. Yes, this person can apply the profit margin scheme. Goods are coming into the list of the goods. So goods are coming into the list of the goods. Goods are being bought from the unregistered seller and goods have already been taxed in the UAE. Means tax on these goods have already been paid to the FTA. So this person can apply the profit margin scheme. If this person is applying the profit margin scheme, this person will be selling 150K, buying 100, 150K less 100, 2.38 will go to the government. Now, this party is buying 150K. They are not claiming any input tax because the invoices that were issuing in the profit margin scheme, VAT is not reflecting anywhere. So we are selling 150K. They are selling 150K. They are selling 170K. Net amount 170K less 150K into 5 divided by 105. 1.19 is going to the government. So this person can apply the profit margin scheme as well because this person is buying the goods which are in the list from a person who is already applying the profit margin scheme. So these are the few examples. Now based upon this example, basically you will be able to understand what the exactly law says, what are the requirement, what are the compliance requirement, what is the documentation requirement. This is the profit margin scheme is method of calculating VAT for businesses that sell goods or services at a profit margin. We know that what is the profit margin. Profit margin is sales, gross sales, that's gross purchases. Instead of paying VAT on the total price, businesses only pay VAT on their profit margin, which is the difference between the purchase price and selling price. We have already discussed. Scheme simplifies the calculation for uncertain businesses, particularly in second-hand goods, where the traders are involved. They are buying the goods, selling the goods. Law says instead of going into the detailed calculation, maintaining a lot of books, claiming input tax, going into the complication for trader, they have made it very simple. Sale purchase differential, you need to consider this is a VAT inclusive value, you need to pay output tax. No doubt there will be certain loss to the government, but it will give ease to the businesses. This is the, I think, one of the major reason for implementation of the profit margin scheme. These are the benefits. cash flow improvement. Whenever you are buying the goods, you will not be paying any input tax to the supplier. Simplicity means you are simplicity. Sales less purchases, 5 divided by 105, net amount will go to the FTA. This important encourages trade. This is very important. Lower price of second-hand item without any heavy burden. Basically, it will give you business competitive advantage. Easier for businesses to sell low price or second-hand goods without a delay and VAT burden. Then the last is reduced compliance cost. You will not be required to claim input tax. Have proper purchase invoices in hand, issue proper tax invoice. No, law says whenever you are issuing the tax invoice, it will be carrying only gross value without the VAT. Whenever you are buying anything, you need to issue, with requirement of the law that you need to issue invoices on their behalf. We'll look into this. So this is the exact requirement of the law. Law says, this is the article 43 of the law. Law says the registrant may in any tax period calculate and charge tax based on the profit margin earned. May, first of all, this is important. Law says may, this is not compulsion for you, this is optional scheme. Calculate and charge tax based upon the profit margin earned on the taxable supplies as specified in the executive regulation, not based on the value of these supplies, and shall notify to the authority. So this is the law. What the regulation says, these are the regulations. Article 29. Article 29 of the regulation says the taxable person may calculate tax on the supply of goods by reference to the profit margin in the following situations. What are those following situations? Tax already been paid in the, we've already discussed, three conditions. Tax already been paid, goods are being bought from the unregistered supplier, or goods are being bought from the person who is already applying the profit margin scheme. So where he has made a supply of a good mentioned in clause 2, a person is not a VAT registrant. The person is not a VAT registrant. Who is supplying the goods is not a VAT registered individual, unregistered party. Taxable person who calculated a tax on supply be reference to the profit margin scheme. Our goods are being bought from the taxable person who is already applying the profit margin scheme. Basically, these two conditions are there. This or this, any two of them. If this and third is this, the tax already been paid. Where a supply of goods for which input tax was not recovered in according, we cannot claim input tax. As I already told you, goods, basically to claim the input tax, you must have a proper tax invoice in hand, right? And once I'm asking, you need to have proper tax invoice in hand. On that tax invoice, you will be able to find the gross value and along with the VAT as well. Under the profit margin scheme, whenever you are getting the invoice, this invoice is not carrying any VAT. Whenever you are getting the invoice from the reseller who is already applying the profit margin scheme, or whenever you are getting the invoice from the individual who is not registered for VAT purposes, in both of the cases, whenever you are getting the invoice from them, that invoice is not subject to VAT. Once that invoice is not subject to VAT, VAT is not anywhere reflecting on the invoice, you cannot claim input tax on those goods as well. So third, they are asking, this is article, the goods to which clause 1 of this, on which goods this you can apply the profit margin scheme. They said movable second-hand goods. I will just give an example of the car. Then antiques, goods that are more than 50-year-old. This is a requirement of the law. Collector's item, meaning stamps, coins, currency, any other pieces of scientific, historical, and archaeological interest. So these are the items on which you can apply the profit margin scheme. You cannot apply the profit margin scheme on all items. These are the specific items on which you can apply the profit margin scheme. Otherwise, you cannot apply the profit margin scheme. Law requires a taxable person may not elect to calculate tax with reference to the profit margin in respect of goods, therefore be if the tax invoice or the other document is issued for the supply mentioning the amount of tax. This is very important. If you are applying the profit margin scheme, you cannot issue the tax invoice which is showing the VAT on its face. You need to show only one lump sum value, and you need to write one line at the bottom of it that the invoices are being issued under the profit margin scheme. So if you are issuing the invoice which shows the VAT on the face of the invoice, then it means you cannot apply the profit margin scheme. Then profit, what is the profit? We have already discussed difference between the gross selling price and gross purchases. This is profit margin. It will be considered inclusive of VAT. I have given you example 120K. Okay, sorry, 175K less 100K, whatever. We will consider a VAT inclusive value. So we said 5 divided by 105, it will be considered VAT that you need to pay to the FTA. Record to be maintained under the profit margin scheme. Which record you need to maintain under the profit margin scheme? Stock book. A similar record showing details of each goods purchased and sold under the profit margin scheme. Very simple, basic thing. Purchase invoices. This is important. If your supplier or the person who is selling the goods to you or the person from whom you are buying the goods, if that is a VAT unregistered party, then law says you need to issue tax invoice on their behalf. And what are the requirements that we're discussing in the next slide? So when the goods are purchased from person who are not registering, means any car company is buying the goods from the individual. Once they are buying the goods from the individual, the taxable person must issue an invoice showing detail of the goods to himself. They need to issue the invoice. The car company which is buying the goods from the individual, this car company needs to issue the tax invoice for itself, for himself, including at least the following information: name, address, TRN of the taxable person, who is basically seller. Sorry, name, address, who is the buyer, car company. Name, address, and person selling the goods. Seller, name, address. Date of purchase, detail of the goods purchase, consideration payable, signature of the person who is selling the goods. You need to issue an invoice. So this is very clear. If you are buying the goods from the person who is already applying the profit margin scheme, then this clause will not be applicable, because that person will be issuing you the invoice, and they will be issuing the invoice under the profit margin scheme. But if the person who is individual and unregistered and selling the goods to you under the and once you wanted to apply the profit margin scheme, then you need to issue invoice on behalf of that person, but you need to issue the invoice to yourself, and that invoice must be carrying these basic information. The invoice to be issued under the profit margin scheme, we have already discussed that you cannot issue the invoice which is carrying the VAT on its face value. You can issue the invoice. It will be carrying one gross value, and one line will be there that the tax was charged with reference to the profit margin scheme. This is the requirement of the law which has been mentioned in the Article 29 of the regulations. Just look into this example. G purchased a second-hand car from a private individual for 100,000. The private individual has purchased car in 2018. Means G Limited purchased a car from private individual. Means seller is individual. Car has already been taxed in the UAE in 2018. 5% VAT. In 2019, G Limited resell the car 121,000. Calculate the supply under the profit margin, VAT under profit margin scheme. So what is the purchase sale price? Gross sale price is 121,000. Purchase price is 100,000. Difference is should be 21,000. 21,000 is my gross margin. So what should be the VAT? 21,000 divided into 5 divided by 105. 1,000 will be my net amount of VAT that I need to pay to the FT. How to report in the return? How to report it in the return? Gross sales, assuming we need to report in the box number 1. Box number 1 need to report it 120,000. And how should it be the VAT? VAT is 100,000. VAT is 1,000. Just I got one important apologies for this. So how did you report it in the return? In the return, you need to show gross sales, because the gross value of the car that you sold is 121,000. 21,000 is your gross margin. Sales inclusive of VAT is basically 121,000. So 120,000 you need to report it on the box number 1 in the gross sales area. 1,000 you need to report in the output tax VAT in the box number 1. And 100,000 you need to report in the box number 9 of the return, and box number 9 will have a 0 VAT. There is a possibility that in the return might be you are reporting 1000 is my output tax, and you are grossing it up 1000 divided by 0.05, you are showing 20,000 as your gross sales, but this is wrong. It will not have any impact on the amount of VAT, but this 20,000 we cannot report like this. We need to break this 20,000. 120,000 will be showing in the gross sales, and 100,000 will be shown in the gross purchases. In the input tax column, you will have a 0 input tax. In the output tax column, value will be 1000. You need to be looking to this, is very important. So if I'm going to the summary, this summary was issued by the FTA as well. When we can apply the profit margin scheme, you need when the business purchase the qualified goods before 2018, you cannot apply profit margin scheme. Whenever you are selling such goods, you need to charge straightforward 5% VAT on the full value. Goods were bought after means goods has already been taxed in the UAE. Now the question is, are you banned from the individual or from the person who is already applying the profit margin scheme? A good previously incurred in the UAE, yes, tax can be calculated as per the profit margin scheme. The goods were purchased from a registered who accounted for VAT under the profit margin scheme, or from the unregistered person. In both of the cases, you can apply the profit margin scheme. And even if the goods has been taxed in the UAE in 2018, means you have already registered car in 2018, but you are buying the good from the VAT registered party, which is not applying the profit margin scheme, then you can not apply the profit margin scheme as well. So the crux is important. I'm just highlighting it. If you are buying the good from the unregistered party, if you are buying the goods, specific good that we discussed, are you buying the goods from the party which is already applying the profit margin scheme, and the tax on those goods has already been paid to the FTA at the initial stage or at any later stage, then you can apply the profit margin scheme. Otherwise, you cannot apply the profit margin scheme. So this is just, let me go through the quickly checklist. We have prepared one checklist. You can go through the checklist as well. And one public clarification, you can go through the public clarification. VAT public clarification, profit margin scheme. You can go through this. They mentioned eligible goods. We know the eligible. What are those eligible goods? Summary is previously been subject to VAT before the supply is questioned. This is full selling price of the goods. Detailed discussion. These are the goods on which you can apply second-hand goods, antiques, or collections. Conditions: goods have been purchased from either unregistered party, the supplier calculated VAT, and the supply basically supply is applying the profit margin scheme, or this is supplier the unregistered party. The taxed person made a supply of those goods where input tax was not recovered. You cannot recover. I have already told you the reason as well. You can go through this. This is very basic thing. These conditions they have mentioned, and the original purchase was not subject to VAT. You cannot apply profit margin scheme because goods have already not been taxed in the UAE. From a supplier who did not charge VAT on the supply and the goods may have been purchased in a period prior to the effective date of the law, you cannot apply because the goods have been purchased before the effective date of the law. From a supplier, it is known that the goods would have been purchased by the supplier in a period after the effective date of the law. Yes, after the effective date of the law means goods have already been taxed in the UAE. Then the goods is eligible to be sold under the profit margin scheme, where you have evidence to show that the goods have been subject to VAT on the earlier of the supply. The condition I've already told you as well, nothing other than this. I can quickly go through the checklist, and I think we have mentioned the checklist. Okay, guys, take care. Thank you very much and have a lovely evening. Thank you. Bye-bye. One question, who is whenever people discuss profit margin scheme, they always discuss cars sale purchase. Is not it equally applicable on the used household item like AC, refrigerator? This is applicable on the household, movable household items. Yes, this is applicable. You can apply this because law says movable second-hand goods. Refrigerator, AC, these are the movable second-hand goods. You can apply this. Any other question? Thank you very much and have a lovely evening. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.